Hello again. Our chapter for this week is chapter 6. We had gone over a few minutes ago chapter 5 and we introduced merchandising firms. Today we're going to talk a little bit about inventories and get familiar with the accounting for inventories, how they're presented on the financial statements, how entries are recorded, how do we track the flow and record the flow of inventories. This chapter will be very, very important, so it would be a good idea to take the opportunity to read through this chapter all the way through once and then review the various areas such as the flow of goods using FIFO, LIFO, and weighted average. Review those again also before attempting your homework. This is just my suggestion because of the amount of information that this chapter covers is so much. It might be a good idea to go through it thoroughly once and then highlight the very, very core portion of this chapter, including which includes the flow of inventory, separately, just to get an idea of how you're going to be presenting this information in your journal entries, how you're calculating this information, and it can become a little complicated. So I want to just prepare you. This chapter does require quite a bit of information and quite a bit of honing of skills. But the most important thing is we have to make certain that we understand that inventory can be extremely a significant part of an organization's assets, current assets, to be honest. Maintaining them and keeping them protected is most certainly important. Reporting the inventory on the financial statements is a current asset. It's going to be high up on the balance sheet in this assets area. So you're going to see this on your financial statements in your project. It's a very, very small amount on the project, but in general, merchandising firms they generate their revenues almost solely from their inventory. And that being said, it's going to be extremely high number on their balance sheet. And also, what to note, inventory that goes in and go out fairly quickly does give you an idea of the health of the organization. This organization is healthy because it's able to generate revenues. So again, safeguarding inventories means, you're going to have a purchase order. You're going to have an authorization to pay. You're going to have some document that said that you receive it, and you're going to have an invoice from a vendor. All of these work together. Believe me, I have been in accounting for years, and during my early years of accounting, we had 3 different individuals assigned to this task that you're looking at on the screen. And that's important because it's controlling inventory. It's ensuring that it's honest. It's ensuring that there's no theft. If there's something trying to steal, it could be caught quite quickly. So having that process is very, very important. And we sometimes lose sight of that when we're in this class because we're not really dealing with the reality of inventory. But when you think about in the real world, Walmarts and Targets of the world, they have to have some mechanism in place to ensure the integrity of their inventory. They use barcode system, they use cameras and all sorts of things and also all sorts of internal control procedures to ensure that the information that they have on their accounting records match what their reality is, their physical count. So safeguarding inventory is going to be a very important thing. We also talked about this, subsidiary ledgers and what information it provides. The most important thing is knowing that the subsidiary ledger is a subset of what you're going to see on the financial statements. It contains far more detail about every specific type of inventory item that you have. And also reporting inventory. Every organization that has inventory does an inventory count. Generally, it's going to happen once a year, and sometimes it happens more frequently just to, I would say, verify your perpetual inventory records and to also identify something that's obsolete or inventory shrinkage or damaged goods. That becomes important to do an inventory count to remove those items, to identify them first of all, record the entry to remove them off your books if necessary. There's some cost flow assumptions, and you already know what they are: FIFO, LIFO, weighted average. The whole point of it is to show how much your inventory cost using an assumption of how your assets, your inventory leaves your building, leaves your company. Whether first in is the ones that are going to be the first to go, or the last in will be the first to go, or somehow a weighted average number. In the real world, first in, first out is going to be most certainly the most popular of the costing methods. But specific identification method is going to be identified by specific items, and this is usually when you're talking about very, very customized inventory items. Jewelry could be something like that, or maybe a car. But even then, I have not seen in my personal experience specific identification method used. I have experienced the first in, first out, and the last in, last out. I mean, last in, first out. Weighted average, I have not seen either. So I'm going to say, as far as my understanding goes, FIFO is going to be the most used. Then comes last in, first out, and possibly coming in a distant third, maybe weighted average. But again, you're going to be averaging your cost flow with weighted average. You're going to be assuming your last goods that you've purchased are to be the ones that are going to be sold first. And your ending inventory is going to be most certainly made up of your very early or your first purchases. And the opposite is going to be true for FIFO. So again, in a perpetual system, when FIFO is used, you're going to be including your cost of goods sold in in the order in which they were purchased. Now, which one is the best, which one is the worst? The truth of the matter is going to depend on your organization. And it really does depend on the item being sold. I mean, obviously, the last in, first out might very well be applicable to perishable goods, don't you think? I mean, people generally, I mean, if I go to the grocery store and I purchase my eggs, I'm going to go for the eggs that have been purchased last, which has the longest expiration date, simply because I want to have it in my home a little longer. But obviously, organizations use a different methodology when they determine what method works well for them. It really comes down to the flow of goods, what actually happens with your organization, and how the flow of goods actually occur. You may find that your sales dictate the flow of goods, meaning you've consistently seen your first goods that you've sold are the first to leave. And my recommendation would be to use the method that represents the flow of goods that's applicable to your organization. But you will notice, however, with these methods, you will see a very, very different, and sometimes, depending on rising or falling prices, a very significant difference in the ending inventory balances and your gross profit or your cost of goods sold. So when you're looking at that, you're going to notice that. I want you to observe that these different methods of costing can produce and often produce different cost of goods sold and different ending inventory balances, which ultimately is reflected on your balance sheet and income statement. So it's important to note with the periodic, you're not going to be recording at the time of sale your cost of goods sold. Just letting you know, periodic is going to be used. You're going to be recording revenue at each time the sale is made. At the end of the accounting period, the physical count is going to determine your cost of inventory. Again, this is a method that's not commonly used in business, particularly in merchandising firms, simply because it's not accurate. It doesn't give the user sufficient information to make decisions. It's absolutely at the last minute. It's after everything has been done, and it's probably the least likely way to record and show the flow of goods. It doesn't show your flow of goods, to be completely honest. And I could bet you dimes to donuts that you're gonna notice that organizations are going to be using a perpetual inventory system, and they're going to either choose FIFO or LIFO, most likely. So comparing the two, again, the different cost flows are going to give you different ending inventory balances and a different cost of goods sold, which ultimately will show a different gross profit and net income. And again, it's not a wrong or a right. It's what works best for the organization. Your job in this course is to understand the differences among them, how to calculate them, and what it means to the financial statements. And again, if you're dealing with rising or falling prices, you can see a very significant difference in these numbers. Sometimes when you're using it and the prices are not going up so significantly or not falling so significantly, the difference between the FIFO and the LIFO is pretty immaterial. But they are different, and that's important to note. You will see, and it's not incorrect, you will see a different ending inventory balance under FIFO and LIFO. You will see a different ending inventory with weighted average. That's not unusual. It's in fact, you're going to be looking for the numbers to be different to be able to tell how these different methods impact the financial statements as a whole. So reporting inventory in the financial statements, obviously we're always obviously dealing with historical cost. How much did you pay for it at the time the purchase was made? That's basically what we're going to be showing on our books. However, the cost that we are assigning to our inventory is going to really depend on how the inventory values flow. First in, first out, or last in or last out, or an average of those numbers. So again, we're going to make certain that we want to be clear what we're reporting as inventory is going to most certainly be impacted in many ways by the cost of the flow of our inventory. Now, valuation using LCM is going to be lower cost of market. And I have not seen this, but I would assume this happens when you're dealing with different items where a market valuation is going to be kind of important depending on the actual inventory item being sold. I would say this is most certainly not often used, but it is most certainly a valid way of using it, of valuing your inventory at the end of a period. The most important thing is knowing those differences, what they are and what they mean, and how they are, how they impact the financial statements, more so than calculating, because in this course you're going to be really emphasizing weighted average, FIFO and LIFO. Inventory is going to be on the current section of the balance sheet clearly, because again, we're assuming that these inventory items are going to be sold within a year. We are not going to be holding inventory over a year. Again, we're talking about a merchandising firm, and merchandising firms generate their revenues from their inventory. Thus, it makes only sense to say that we get inventory within a year, we're going to sell it within a year. That's the assumption here, and it's important that you know that. And also, in this particular site, the thing that I want to just communicate, it's going to be a lot of information in your textbooks, and you can go into the details of that. But it's important to see if there's a mistake. What happens when there's a mistake? What happens? What do you do? And how do you account for errors? So when you're looking at all of this, it becomes necessary to think about the relationships among these various items, how they relate to one another, and how they relate ultimately to its presentation on the financial statements. That's the key. So understanding the effects of inventory errors really helps you understand the relationships among these variables, whether it be inventory costs, whether it be the FIFO LIFO methods being used, whether it has the effect on the balance sheet, overstating the inventory or the asset, understating the asset. What happens? What happens if this inventory asset is understated? In the inventory? What happens if the cost of goods sold is overstated? What happens to the balance sheet? What happens to the income statement? Understanding what these errors mean and how they affect the financial statements is very important, because it's going to really tell you how it's going to show and how you can fix them or correct them on your financial statements. So I don't want to go into all the details of how errors occur. My job and my hope with you is to understand what the relationships are among these variables, and how would an error affect the financial statements. What happens when a mistake is made with regard to the valuation of ending inventory, or a valuation of cost of goods sold, or your calculation of cost of goods sold? If it's overstated or understated, what would be the effect? How does it affect the balance sheet? How does it affect the income statement? Also, note that inventory includes consigned property. A consigned property means you are a retailer and you have some products, and you decide to have another organization sell them for you. You become the consignor, and then the organization who's holding and ultimately will sell will be the consignee. Now, until that item is sold, the consignment, when it's in a consignment situation, you are actually holding on these inventory items on behalf of the consignor. It does not leave your asset until it's actually sold. So the unsold merchandise at year end not only have to report the inventory that you have on your hand, but also the inventory that's consigned to a consignee at some point. And you have to record and reflect consigned goods as a part of your inventory. Even though it's not in your warehouse or in your stores, it's still your inventory. Until it is sold, it belongs to you and is part of your assets. And that's all this screen is really telling you. Now, the other particular a ratio that you'll need to understand is the inventory turnover. It really does tell you the relationship between your inventory and your cost of goods sold in a period. It measures how much your inventory is turned over or is converted to a sale. Very important to assess that, because you need to understand that if you are selling your goods quickly, that means you're generating revenue. That means you're healthy. It is one of many indicators of an organization's health, its ability to generate revenues. So this is a very important calculation, which you will ultimately discuss in a report, and also when in your project. So knowing how fast your inventory turns over or your inventory sells is one of the many critical ratios that you can calculate to measure your efficiency with generating revenues for your organization. The final ratio that I think is important is number of days in inventory. This, again, the number that you calculate, if you're going to perform the calculation which you see here, average inventory divided by the average cost of goods sold, no big deal. But the main thing about this calculation is interpreting its meaning, and it will depend on the actual item that's in your inventory. Some sales of inventory move faster or slower than others, and you need to take that number in consideration of that particular inventory item. Don't just say, okay, if I have inventory in my warehouse for 45 days, that's bad. That's not necessarily true. It could very well be that this particular inventory item takes 60 days to sell and you sold it in 45, in which case means that's a good thing. However, if your inventory comprises of food and grocery items and it takes you 45 days to sell your eggs, that's not a good thing. That's a bad thing. So utilizing the ratios really helps, is very important, but it's important more than anything to understand the mechanism by which the analysis is being formed. How and what this information means, how to apply it appropriately to the situation to make a rational and logical decision. So don't just use the ratio, don't just use the number that you're calculating and make an assessment. Look at what you're calculating and why you're calculating it, and then evaluate it as a whole. So if depending on the inventory item, the number of days that it takes to move could not necessarily mean it's bad or good. You have to look at the details to make an assumption, to make that decision. So as I said, eggs being in your inventory for 45 days is not a good thing. But if you sell your products, or you sell cars in this case, and it takes 45 days to sell a car and you sell it in 15 days, that's a good thing. Or if it takes 6 months to sell a car, you sell it in 2 months, that's a good thing. So look at the situation in light of the industry average to make certain that your determination of this being bad or good or indifferent is appropriate. This is most of the chapter that I really wanted to go over, because I think it'd be critical for you to understand in order to get through your homework as well as get through your project. You will be talking about other different items and different ratios, but for the most part, these ratios that we've gone over in the FIFO and LIFO method, as well as weighted average, is going to be the critical components of this chapter, which I believe this overview provides you. So I'm hopeful that you have learned much and that you will be able to calculate your inventory and cost of goods sold under all three methods using the perpetual inventory system. Thank you very much for listening, and I will talk to you very, very shortly.